FX Nation, what's up, guys? Welcome back to ForexU in our advanced course, and welcome back to Market Maker Trap Moves, Part 4. Alright, guys, so this is going to be the last video in the Market Maker Trap Moves series. So this is the last one, Part 4. Alright, so again, we're going to continue to talk about Market Maker Trap Moves, and we're going to continue to talk about trap candle patterns. We're going to talk about dealer structures, and we're going to talk about market maker behaviors. All right. So remember, guys, trap moves are made up of trap candle patterns. You got to understand the dealer structures, and out of everything is market maker behaviors. If you can just understand that, guys. All right. So let's get this going here. What are we talking about today? So the first thing we're going to talk about is the spike. So what is the spike? How do we define the spike? What does it do? What does it entail, right? So basically, it's an aggressive change in price, usually following a news event or a news announcement, right? So 8:30 news that comes along, 2 p.m. FOMC news, right? It's a spike that happens usually following the news events. Now, this is actually used to trigger the stops and move the trading zone, right? So you ever remember when the news would hit and it would go, let's say, short, spike down, and then rise right back up and move away from that zone? That's exactly what the spike is. It's exactly what the spike is, right? Remember when the news hits, it goes, fakes out in one direction, spikes up, and then boom, goes in the actual intended direction. They shift the zone from the retail traders. That is what the spike is, ladies and gentlemen. And then the direction is based solely upon the dealer open volume. So very important that you notice that the spike is based solely upon the dealer open volume. So depending on how many net shorts and net longs they have available. Okay? So remember that. And then also, it has nothing to do with the retailers, with the retail traders trend. Okay? Remember that news events are used to primarily do what? What are the news events used for? They're typically used to finish off patterns, right? They're typically used to finish off patterns, right? Let's say second leg W or second leg M, news events come, right? You get a false move to the bottom to create the second leg of the W, and then it spikes straight up, right, to complete the move, right? So the spike being the false move down that created that second leg of the W, to go back up. So that's what we're talking about. So let's take a look at some examples of some spikes, so we know what we're looking for and what does that look like actually on a chart. So let's take a look. All right, so this one here, you can see Asian range here is 26 pips, and immediately what happens? Boom. Look at this spike up here that hits, right? This is basically 4:30 news right here. Look. Spike up hits, and they shift the whole zone away. You see that? The whole zone, they shift, and they start going down. Right? Sometimes what you will notice as well is that these spikes basically start to create the structure, the outside structure that we're going to talk about. Okay? After the spike here. All right? So I want you to just notice what the spike actually looks like, though. It's right here. Look. There it is. Nice big spike. Look at this one. Move up. All the way up. Spike. Come straight back down. And then they start to move sideways. And then they eventually actually drop. Again, spike off the Asian session here. They move up. They spike and move away. They shift the zone as soon as possible. Look, this ends up in a railroad track. See that? Railroad track, they spike and they move away from it. Same thing here. Move up, spike, railroad track, and then just move down. This one right here is actually showing you the whole structure as well that we're going to get into after we talk about spikes. But you can see the structure here, the outside structure. Creates the first leg here, starts moving sideways. They spike up right here to get as many traders going long as possible, because this basically creates peak formation high here on this one. All right. But that's the same thing, I believe. Yeah. It's the same thing, just a closer picture of it, so you can see what it looks like. But you can see they spiked it from here, and then they just moved down. They just continue to move down from it. This one here, look at this one. Big spike up, all the way up to touch yesterday's, the previous day's high. See that? And then come all the way down. This is all, what is this, news? This is all news right here. Big indecision candle going up, coming back down, doesn't know where to go. All based off of news. Here's a spike again, right here. This one actually spikes down, comes all the way back up, plays with you for a while, and then they hit it again. See that? But originally, when this news hit, this was FOMC news at 2 o'clock. What happens? They spike up. Right here, they spike up, and then come straight down. You see that? Straight down, straight down, straight down. 3 bars, and it's like, what, 100 pip move based off of FOMC news. But that's what a spike is. Let's talk about outside structure. What is an outside structure? What's the definition of an outside structure? It's simply like this. It's the V shape in the half a bat trade. Remember the half a bat trade from, I believe, the first video? That straight V top that goes up and then it moves sideways. That's the first leg of the outside structure. All right, I'm going to show you plenty of examples of that so you know what you're looking at, but that's what it is. It's a V shape in the half a bat trade. Intraday, it's used to set the high and the low of the day as a single leg. You ever had that scenario where you had essentially you didn't have an M, you had basically just a V, a big V, right, going down, straight back up again. And you're like, man, it didn't do a second leg. Or it had a V top that went up, came right back down, right? Created the high of the day, low of the day. That's what that is. It's the outside structure. It's also used to set the high of the week and the low of the week. So this outside structure will create the high of the week, low of the week. Okay? So think about a lot of factors that come into play when you're talking about creating a high of the day, low of the day, but also that same moves creates the high of the week and the low of the week. All right? So here we have outside structure. So what happens? We have basically a move that's coming down, as you can see from the EMAs. They spike it. You see this? Look, they spike it down, come right back up. They move sideways, and then the next day, what happens? Railroad tracks right here, and then they move up and away, and they start the count, right? So this right here is that V shape. Okay, it's like the V shape in a half a bat trade, right? The only difference is that we're talking about a bigger outside structure, the bigger picture, right? So this moves sideways here for like a whole day, right? For the rest of the day and then into the next day. And then they finally move out. This move literally just happened on Euro Pound. Okay? This move just happened on Euro Pound yesterday. Okay. So that's what the outside structure looks like. Let's show you another one here. What happens? Big spike up here. Look. Goes up. Comes up. See the big A top here? They come up. Hit it again. That high is never penetrated. This is the high of the week. Look. Beginning of the week is here. This is the high of the week already being created on a Monday. So you already know what's going to happen the rest of the week, right? When it comes to, like, let's say a cycle, right? You're going to be in a downtrend cycle. You know what I mean? So they move sideways, and then Tuesday, the bottom drops off. It just keeps going down and down and down the rest of the week. But this is the outside structure that creates it. To high of the day, high of the week, move sideways, and then drop. Here's another one. Same thing. Same thing. This is Wednesday, creating the high of the week. Okay. Wednesday creating the high of the week. They go sideways. Thursday, you see how the high of the week never gets penetrated. It's protected. Right? And then they just drop off. Look, they just drop off. And it just continues on for Thursday and then Friday. Look at this one. High of the week Wednesday. Right here again. Wednesday high of the week. Look, they move away, move sideways, and then during the next day, they shift the whole zone away. And then they go on and they drop. Right? A lot of times, basically, you can compare this to essentially creating, like, let's say, a peak formation high or a peak formation low. You know? It's the first leg, essentially, of that. You know what I mean? It's what helps create that. That's why a lot of times when you see peak formation highs, peak formation lows, you see that V-shaped top like this, and then they move sideways, and then sometimes they either go back up, right, and then take the zone away. But most of the time they don't. They just move sideways, and then they drop. Here's another one. This is on here. Beginning of the week is here. This is Friday, right? So this is basically the low of the week right here because we're coming off of a trending down cycle. You can tell by the EMAs, right? So we're coming off of a downtrend cycle. Here's the V shape right here, right there. Goes sideways. Sunday, Monday comes. Guess what? They're gone. They shift the zone away. Okay. Look at this one. So here we have, again, downtrend cycle from the previous week. This is beginning of the week, false move Sunday, Monday. Right? Here's the V shape right here. Here's the V shape right here. What happens next day? They actually come back down, retest, like I was saying a couple seconds ago. They come back and retest, and what happens? Boom, they're done. It's a multi-session W, right? Creates the low of the week. Creates the low of the week, and it moves away. Okay, now what can you expect for that? You can expect to go in one direction pretty much for 2 to 3 days, right? Because we're coming off of a downtrend cycle from the previous week. Right? Sunday, Monday, they just happened to end that cycle because it's created the false move sideways, and then boom, hit that low again, and then move away. There's your low of the week for that week right there, and it just creates a multi-session W. Look at this one here, same thing. Coming down, does a V shape right here. Goes sideways, and then boom, starts to move away and goes up. Okay? It's the same thing, different variations, same theme. All right? Different variations, same thing, guys. It's all it is. Same thing over and over and over and over again. This is all off of one pair. This is not like I had to search really hard for it. You know? Look, here's Thursday. High of the week here creates the first part of the outside structure. Comes back. Next day, goes right back. Hits that right here. This what creates multi-session M here. And then they wait out the week. And then on Sunday, Monday, they go ahead and drop it. Remember, this is the high of the week here. Right here for that week. High of the day, high of the day, high of the week. Right here. And then in this case, here's the next week that starts Sunday, Monday. And then you can see the ask completely drops out. It's a whole shift that happens. Look at the EMAs. They're spread eagle. See that? Look at the 800s all the way down here. See that? So this is an entire big movement, basically a change of a trend, right? This creates peak formation high. This one, same thing. Look, straight down. This is what? Sunday, Monday. This is Sunday, Monday. Comes straight down, makes the V. Comes straight across. They come back and retest it here. This is, I believe there is a news event here that made this spike come down for the U.S. session here. But look, same thing. The low doesn't get taken out, right? We still have the low of the week, and then they move on. Look, the EMAs are telling you, look, this is a change of trend. We're going from down, now we're going up, right? It's a big U, it's a big bowl. You know what I mean? That's all it is. So the outside structure, this outside structure here, just creates the anchor point basically for the change of trend to happen. It's all it's doing. This, again, Sunday, Monday, right here, here's the beginning of the week. What happens? Here's the outside structure right here, creates high of the day, high of the week. Right here goes sideways on Tuesday and then just drops. You can tell that we're coming off a cycle that was a trending up cycle. How do we know that? Look at the EMAs. You can't even see the 800. The 800 is down here somewhere. So you know that we were in a trend the whole time, and now that trend is changing. Look, as soon as we pass this 200 EMA here, okay, we're now going to, the only thing we have left is the 800 to get through, right? And so this creates a whole change of trend. From going up, now we're going back down. All right? But that's all it is, guys. Look, this is really simple. Don't complicate it. It's the outside structure right here. High of the week, high of the day, moves sideways, and then drops. That's all it is. Okay? So those were the spikes. Those were the outside structure trap moves that the market maker does. All right? So let's talk about this real quick. So market maker trap moves. The main defense that you have is to learn to identify the market maker behaviors. Once you understand the behaviors that they do, I'm telling you, it changes everything for you because you got them. It's just like, imagine if you guys are parents and have little kids, right? And you start to learn how your kid acts, when they're a little baby and stuff like that. And imagine, as you start to get to know them and you start to understand their behaviors, what they do over and over and over again, you really start to know and understand what they do, so you can kind of expect, what happens when they're quiet. You ever hear the saying of, like, if you have like a 2-year-old or something and you don't hear noises for more than 3 minutes, you better go check up on them because they're doing something. Because they're probably in something, doing something bad. So it's the same concept, guys. Just understand the behaviors that market makers do. Okay, start to analyze and think like them, and start to think of how do you trap these traders? How would you trap the traders if you were a market maker? The faster you can understand and realize that, the faster it's going to help you to understand the behaviors and the trap moves that they do. Always trade with market makers and never against them. All right, so this is like the number one rule. Remember when they say the trend is your friend? Well, in this case, market makers are your friend. Don't ever trade against them. There's no point in trying. There's literally no point in trying to trade against market makers because you're going to lose. They have way too many resources, way too much money than you, way too many more people than you. You're just one person. All right? You want to just ride the coattails is all you want to do. You just want to grab the coattails and just go along for a little bit of a short ride. 30 pip ride. That's it. 30 pip ride at a time. You know, we're not asking you here to go 100 pips every time. We're asking you to just get 30. Just ride the coattails for 30. That's it. Trade both ways without fear when signals present themselves. So don't be stuck in one of the biggest mistakes that I did when I was first started to trade this type of strategy like this is that I had a strong bias in one direction. And so when I had just that one strong bias in one direction, I couldn't open my mind to possibly trading both ways based on what they were giving me. Okay? And so that basically lost me a lot of trades because I wasn't open-minded to the possibility of being wrong in my directional bias. Okay? So understand that the directional bias is one small little tiny part. Okay? And you need to just see what they're giving you and trade what they're giving you. Okay? Trade the patterns that they are giving you. Understand the outside structure, understand the railroad tracks, understand everything. It takes a while to get it, but once you understand everything and the behaviors, trust me, it makes a world of difference. But very important that you have to be open-minded to trade both ways. Okay? Because you might have, on one day, you might have basically a type 1 setup during London that turns into a type 2 setup during the US session. Right? And so you got to be able to trade both of those, not just one. You know what I mean? So just understand that, guys. Understand that. And finally, market makers create sentiment and then act against it. I think we just talked about this in the group session, right? About the market sentiment. If you go to any of these websites, let's say dailyfx.com, they show you the IG broker sentiment of their retail traders. So meaning how many traders are going long to how many traders are going short. So they'll say 70% of traders, let's say on Euro USD, are going long and 30% are going short. What does that tell you? They have traders trapped going long. Market makers are going short. Okay? So understand that market makers create the sentiment and act against it. All right? All right, guys. Some major keys here as we wrap this up. So number one is a fast move is a false move. A fast move out of the box is a false move. All right? So anything out of that Asian box that's fast moving is a false move. Okay? So keep that in mind. Don't chase rising or falling currency. Don't chase. Don't be a chaser, guys. Okay? We're not here to chase. Okay? We're here to trade a trading setup. We're not here to chase anything. If you're chasing something, stop trading. If at any point in time you think you're chasing a trade, don't chase it. Get out of the trade or don't enter the trade. You shouldn't be chasing a trade. There's no reason for you to be chasing a trade. You're chasing a trade, that means that you're gambling. If you want to gamble, you have better odds going to a casino than trying to do it on Forex. I promise you. Because at least when you go gambling, you can pick a game that you actually like. All right? So remember that market makers drop to buy and they rise to sell. Okay? Think of it like a pump and dump. Remember back in the, Wolf of Wall Street, they were pumping the stocks to then sell them? Right? Pump and dump. It's the same thing. Market makers will drop price, will make that aggressive move, that false, fast move down because they want to buy. Just like they'll make the false move up because they want to sell. Okay? A powerful or extended move is always followed by consolidation to bring traders back and set up level 3. So a big move or an extended move is always followed by consolidation. Okay? What happens typically when you get a big spike up in one direction when news hits, right? And you go up 100 and something pips in like one candle. What happens the rest of the day? Tell me what happens. It consolidates for the rest of the day, right? Because the move has already been done. Right? So that's what I'm saying. A powerful and extended move is always followed by consolidation. Typically, that's where you're at level 3. All right? So keep all these major keys in play, guys, when you're thinking about trading with market makers and you're trying to identify market maker trap moves. Okay? So, guys, thank you so much for watching this series of market maker trap moves. I'm glad we were able to get through it, and I hope that you learned a lot of different aspects about what market makers do to trap you into trades. All right, guys. Thank you so much. Enjoy the rest of your week, and until next time.